Recording.
Hello, everybody. We've been having some technical difficulties, so I apologize for being late. It takes technology to really mess things up. And I'm here with my good friend and colleague, Marla Barch with Cross Country Mortgage, and we've been having fun with technology. So we've got some interesting slides to show you, and graphs and charts, which I get into, and some ideas about what's going on in the market. So Marla, you want to say hi and add anything?
Yeah, hi, thanks Mary for organizing this. Hi to everyone watching. Yeah, we're just excited to share with you where the market is. It's extremely exciting out there in the real estate and mortgage side of it. So yeah, let's jump into the slides and show them what we're seeing in the market.
I mean, I guess we should preface this by saying that I think people are expecting that the market and the economy and because of the pandemic has come to a grinding halt. That's the expectation that people, I think, would have in a normal recession. That would be true, but that's not what we're finding at all. And I think you'll be interested to see that that the data is not supporting that. So let me pull up my charts and graphs. Our MLS puts out these weekly charts for us that shows what's going on in the market. They update it every Monday, so next week's data will be up tomorrow actually. But let me go full screen here. And this is showing, you guys don't see the little box, the Zoom box in the corner, right? You're not seeing that, right? Marla, you're not seeing that. Right?
I mean, I see us at the right-hand side.
Okay, but it's not on my screen, right? Okay, because it's kind of in the way.
I don't see the last few bars. Our picture.
Oh, because, okay, let me, okay.
Oh wait, although we can move our picture. Can you pick up our picture and move it so it's not covering those bars?
Yeah, I can do that. So you're seeing.
I'm not sure how it shows on the recording, but I think it's fine. Let's just move forward.
Okay, let's just move forward. Let's quit playing with the technology, right? Anyway, okay. Anyway, so this shows properties that have actually sold and closed, and it goes back to the beginning of March. It's going back like 6 months. And you can see the green bars are 2019, the blue bars are 2020. And this, of course, is right about the time that we shut down. So you can see that actually 2020, we were having a more robust spring market than we had been in 2019. And then shutdown occurred and things kind of, now these are closed sales, so there'll be a lagging indicator, but you can see that our closed sales have not yet quite, have just about caught up to what they were in 2019.
So closed sales, we're talking about 30 to 45 days from when they go under contract. So we're looking at closed sales from July that are happening right now, probably went under contract in like May, the beginning or middle of May, right?
Right, so everything that's starting to, everything that's closing now is properties that were sold during the pandemic, after lockdown.
Right.
This is showing properties that went under contract. And here again, the green bars are 2019, the blue bars are 2020. And you can see that our spring market had started out pretty robust, shut down, but look what's happened here. So it's basically, this is Memorial Day, this is 4th of July, but these are properties going under contract. So this is what's happening right now today.
So we can see in the middle of May is when people really in earnest went out and started buying houses again. And that's what translated to the closings we're seeing now in July, where we're right back up on closings to where we were last year, and under contract is higher. So these ones that are under contract now will be closing in August and September. So we'll be higher on the closings for those months.
Right, right. And it just shows that basically our spring market was delayed to summer this year. And we're seeing that with the uptick in showings. I know that these are the new listings coming onto the market.
So yeah, we're right back where we were last year.
Yep, exactly where we were last year. I mean, so sellers are coming back into the market.
Which is good because we've still seen low inventory. So we really need the sellers out there. So if anyone's watching and thinking of selling, please, 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 we need more houses. We have too many buyers and not enough houses. So sell your house.
Right. We don't care about this chart. There's a couple charts in here we don't really care about. These are the open houses. You can see open houses have come back with a vengeance. And these are the showings. The navy blue bar is 2019, and the gold bar is 2020.
So basically, it looks like everyone who paused in March and April is out now. So now we have more than we had last year because we had less before. People just waited. They didn't decide not to buy. They just waited a few months.
Right, right, right. And these are, the sales price, median sales price. This is interesting too. I mean, we're basically, values have not gone down. I think a lot of buyers have the notion that, that because we're in a pandemic and because we're in a recession, that prices aren't holding, but that's actually, you can see from this chart.
Well, even from when we did this last month, they were about the same as last year. So just in the past month, even now they're higher than last year. So values have actually increased.
Yeah, a hair. Yep. From 261 to 245. Yeah, that's a $15,000 price increase. 256 to 247. Yeah, interesting. Huh.
Yeah, so interesting. So, and I'm seeing that on my side too, that the values are increasing, and part of that is because a lot of the properties get multiple offers because there's so many buyers and not enough houses. When you have multiple offers, like any sort of auction or bidding situation, people then start bidding against each other to push the prices up. So that's where we're seeing the values go up because people are pushing the prices up, fighting over homes.
Yeah, yeah. I don't want to get too much into the weeds like I did last month on charts and graphs. So I'm not going to go into, I got plenty of charts and graphs. I love charts and graphs.
Me too. We could do this all day.
But Marla, why don't you show us some of your charts and graphs?
Just briefly on rates. Here's the screen. Okay, so this is the same one I showed last month. And this is just some historical average. These are average rates. They're not anyone's specific rates. Of course, some people get higher, some people get lower depending on your credit score, the loan type, the down payment, the property type, all the different factors. So just on average, this is showing you the Freddie Mac rates. And you can see we ended this chart, which was the end of 2018, just below 4%. So here, this chart is starting at the beginning of 2020 here. And so we started at 3.7. Rates have been steadily going down. There was a lot of chaos here, and then rates have continued to go down to where we're at right now. So right now we're sitting right around at the 3% mark. Last week was below 3%. And of course, these are averages. So some people are getting even lower, some people are getting a little higher. But as an average, last week we were below 3% for the first time in history. And I actually want to remind you of a couple of factors that are influencing this. So the Federal Reserve has a lot of power over the finances in the country and the economy. So what I want to remind you here, which some of us may have forgotten about, but right here, this is 2019. The Fed started dropping the Fed funds rate in 2019. August, September, and October, they dropped a quarter each in anticipation of the projected recession, which had nothing to do with the pandemic. We hadn't even heard of COVID. So we were already dropping rates. So the Fed was making it friendlier for mortgage rates to go down on purpose, already starting there. And then once the pandemic started hitting, we see here in 2020, so we have March 3rd, March 16th, they dropped a lot more. So 50 basis points, 100 basis points drops. These drops force mortgage rates to go lower. So all of those correlate to what we see here with these rates going down. The Fed has been controlling that. And then the other thing that the Fed does is they buy treasuries and bonds and other things, which also forces rates down. So one of the bonds they buy is the mortgage bonds. So what we can see here is 2008 was right after the Great Recession. And part of that economic recovery is the Fed was buying these mortgage bonds and treasuries and other things. But this one is specifically mortgage bonds. Oh no, actually this one is all of them combined. Buying them to try to stimulate the economy, to keep the rates low. And what we can see in 2020 here is, look, they've drastically increased how much they're buying. So between dropping the Fed funds rate and buying these bonds and treasuries and things, they have intentionally correlated it directly to this. They are intentionally doing this. Now, some of it's the free market, because in recessions, bonds tend to do well, which pushes mortgage rates down. So a combination of free market and the Fed, and this is what we get, the lowest rates ever. But just as a reminder, these are nice charts and it's fun to look at, but what does this actually mean for people in reality? So as an average, and I'm rounding here to make the numbers easy, but as an average, you can buy $10,000 more of house per $100,000 of purchase price. So if before you were going to buy a $300,000 house, you can now buy a $330,000 house for the same monthly payment. So an extra $30,000 in purchasing power makes a huge difference to people as far as what houses they're looking at. And the reverse of that is the monthly payment. So the monthly payment would be about $50 lower per $100,000 of house. So if you bought a $300,000 house, oh, and sorry, these numbers are per 1% in interest rate. So if rates were 4% versus 3%. So if you had bought a house for $300,000 at 4% interest rate versus a $300,000 house at 3% interest rate, your monthly payment would be $150 lower per month. So that decreases your monthly payment, and it also decreases the amount that you pay over time. And all that extra savings you can put into your retirement accounts, your kids' college savings accounts, have just more liquidity in your monthly budget. So people are really seeing the benefit of these low rates and how much it really makes a difference in that monthly payment and that purchase price. If you can buy more house, you know, especially now with the pandemic, a lot of people are staying at home and realizing, oh, you know, my house was the right size when we were spending most of the day in the office and at school and at extracurricular activities. But now that we're spending most of our time in the house, it'd be nice to have a slightly bigger house, a slightly nicer house, a backyard, whatever those things they want. The rates being lower is going to help people afford reaching those goals.
Nice, that's great. Well, and that's why we're seeing so much activity in the market. I mean, it's a combination of attractive financing and low inventory. It's actually a great time to be a seller right now. We need more inventory.
But even being a buyer, like you were showing on that first chart, rates are starting to push up because of the situation. So if people think, oh, we'll wait till next year, we'll wait till the pandemic's over, if the rates continue to push up higher, and you know the mortgage rates, we don't know, but the purchase prices, if they continue to push up higher, that's going to make it more difficult to get in that house. Mortgage rates, we think, will likely stay low for a while. The Fed has said they intend to continue their path for, you know, probably a couple of years, because even after the pandemic, there'll be some economic recovery happening. But yeah, those purchase prices going up. So definitely buyers should jump in it sooner than later, because, you know, they'll look back and say, oh, I could have gotten that deal, you know, and now it's more expensive in a year.
Yeah, I mean, to jump from $345 last year to, I mean, that's $15,000. What's it going to be next year? You know? So definitely. Definitely now is a great time to be a buyer. And what we are seeing, and you're seeing this too, Marla, a lot of multiple offers on property. And we wanted to just spend a few minutes and talk a little bit about, as a buyer, how you can maybe mitigate, if you're in a multiple offer situation, what to do about that. And there's a couple of different strategies.
Definitely important to make your offer as attractive as possible. If there are 4 or 5, or sometimes I had a client with 8 offers competing against last week, you want to make sure yours stands out to the seller. So Mary, what are the things you're seeing that sellers like?
You know, and this is the thing. I mean, when I'm out with buyers, and if a property is priced well, you know, again, buyers have this attitude, oh, we're in a recession, we're in a pandemic, I can take time to think about it. And actually, No, you don't have time to think about it, sadly. So the first
properties
thing you need
are
to
off
do,
the market. A lot of properties are going off the market 1 day, 2 days, like right away.
yeah,
They're getting a bunch of
definitely.
offers.
Yeah,
So not only do they not have time to think about it, but a lot of people think, oh, if it's a recession, like you said, prices will be low, so I can lowball the offer. No, lowballing the offer. I have one client who has literally submitted, I think, almost 30 offers now because she keeps getting beat out. Because at first she wanted to lowball. Then she learned her lesson, started offering list price, you know, and still wasn't getting it. So, I mean, in a lot of cases, you're having to offer even above list price because there's so much competition.
Well, and the funny thing is that the comps may not necessarily be there because, you know, I can come back to my office, I can pull up comps, but because prices have gone up $15,000,
yeah.
I may not necessarily be seeing the comps. So
well, the reason is because the comps are a lagging indicator. Right. A comp or a comparable sale is something that has closed. So if it sold 3 months ago and now the market is hotter, so that's always a little bit of a challenge on a market where values are going up, is that the comps are reflecting history, not present or future. Yeah.
Right. So, you know, I mean, you don't want to be crazy, but I think as a buyer, you have to expect that you're going to pay a little bit more than what an appraiser may consider fair market value because values are going up. But if you're lucky enough to get in as soon as the property hits the market, which, by the way, our Compass platform allows you to see properties before they go formally into the MLS if a seller chooses to elect to do that.
Wow. That gives you a great advantage.
Right, exactly. So if you've got, even if it's just a day or two ahead of before it hits the MLS, it gives you that little edge. But and you can get in there and you can make an offer, you know, make a full price offer. If you're the only, if they're not competing with other offers, I would say make a full price offer, shut down the competition, have the seller just button it up and be done with it. And another way to make your offer attractive is put up as much, well, you have to have, before you even make an offer, you got to meet with Marla and get your pre-approval done. Absolutely. You have to have a pre-approval because no listing agent is going to even consider an offer, a legitimate offer, without a pre-approval letter from Marla or, well, from your lender, but
from a qualified lender though, because some listing agents won't accept pre-approval letters from lenders that are known to have a high fallout rate and bad pre-approvals. So a good lender, let's put it that way.
Yeah, a good lender, because like real estate agents, not all loan officers are alike. There's loan officers that know their craft, and there's loan officers that are brand new. And if you just call up Bank of America or Chase and walk in, the chances of you getting a loan officer with great experience that really knows what they're doing is not great. Would you agree with that, Marla?
There's a variety of reasons that go into why certain types of lenders and big retail banks are not known for mortgages. I mean, in general, those companies are focusing on other products. They want their investments, and they've got their car loans and checking accounts and savings accounts. The mortgage part of their business is not the primary part, so they don't focus on that. So they just have a different model. So I would say mortgage companies they only do mortgages. That's what they focus on. They're going to have a model that's focused on doing much better on mortgages than a company that's focusing their attention on getting more investment dollars. You know, and their mortgage division is just a small piece of what they do. So yeah, there's a lot of back end, but definitely a lot of realtors will not accept pre-approvals from some of those companies.
Some I never heard of lenders.
Yeah. I mean, some of them just have bad reputations. Their idea of a pre-approval is, I looked at the credit score, it seemed good, let's throw it at the wall, see if it sticks, rather than doing a thorough job of looking at the pay stubs, the bank statements, the tax returns, looking through the credit in detail, running it through the underwriting system. A lot of companies, they don't have their loan officers doing that on the front end. So you've got a 50-50 shot. They're literally just throwing it at the wall, see if it sticks. So a real pre-approval is done to the level that the underwriter would do it. So you know you've reviewed everything, you didn't miss the fact that the buyer pays child support, and that's a debt that has to factor in. You know, you have to ask all those extra questions. So as a consumer, it may be difficult to distinguish which loan officers are good and giving you good input and a good pre-approval versus which are not. And I'd probably refer to asking your realtor about that, because they'll be knowledgeable about which companies have better reputations.
Right. Yeah, absolutely. So step number one, get your pre-approval. Step number two, make your offer as strong as you possibly can. And some of the elements are, you know, it's not even necessarily about having a big down payment, because there's many low down payment programs out there that are, you don't even have to go FHA. There's conventional 5% down programs.
Even 3% with conventional, and down payment assistance sometimes even lower. So yeah. So sometimes sellers will look a little askance at an FHA offer because of the FHA appraisal requirements. They may have to do some fix up, which they wouldn't be required to do on a conventional loan. So, so you don't necessarily have to go FHA for a low down payment, but and then is put as much money on the table, earnest money, as you can up front. And another thing about the pre-approval letter is I like to ask my lender to give a strong approval letter as possible, even if the buyer is approved for $300,000, let's say, and they're offering on a property that's listed for $275,000. I'd like to see a pre-approval letter for $300,000. Not that you're going to pay $300,000 for the property, but it just paints you as a much stronger buyer to the seller. That, oh, what you can afford and what you're willing to pay are two very different matters. So, you know, if you're well qualified and can well afford the property, I'd like to see a pre-approval letter from your lender that reflects that. And then finally, Marla brought up a tactic that we use called an escalation clause, which you would use in a multiple offer situation. I mean, the hope would be that you could get in early, submit an offer that you know the seller will accept, and shut down the competition, so you don't have to pay, so you don't have to be in a multiple offer situation, which is just stressful for everybody all the way around. But if you are in a multiple offer situation, you know, I've had some buyers say to me, oh, well, we don't want to get into a bidding war, so we're not going to offer, which I never understood that. I never really understood that, because if you don't offer, you end up in the same place as you would if you did make an offer and didn't get it. So it could cost you nothing to make an offer. You might as well go ahead and see if you can get it. And if you don't, you know, you end up in the same place. You've lost nothing. You've got everything to gain and nothing to lose. So I wouldn't be afraid of making an offer in a multiple offer situation. I would go ahead and do that anyway. But there's a little rider that we use called an escalation clause. And what that rider is, and you could sort of fill in the blanks on it, but basically what it says is that you're willing to pay a certain dollar amount over the highest offer that's on the table. So if the highest offer is, let's say, $300,000, and the escalation clause basically would say that the seller, that you as a buyer are willing to pay at least something like $2,000 or $5,000 or whatever the increment is that you're willing to pay over and above the other highest offer that the seller has received. And the agent is supposed to show you at least the face of the offer to show you that they have a legitimate bona fide offer that you're competing against. And the escalation clause also has a cap. So you're willing to pay a certain amount over the highest offer up to a maximum. It's not just
right. Yeah, it's not just, yeah. So if somebody's come in and they're offering $400,000, you know, you're not stuck. You're not on the hook for that.
Yeah. So the one client I had mentioned earlier that won in an eight offer situation last week, they had an escalation clause. So they went $2,500 above the highest offer up to a certain maximum, and they were able to win that way against the seven other offers on the table.
And it's got to be enough of an increase over the other offer to make it worthwhile. I mean, $1,000 I don't think is enough of an incentive for a seller. Yeah, because rarely are all things equal in terms of offers. I mean, one offer will have a larger down payment or a quicker closing date or something. So it's not always just about price. Sometimes it's about the terms as well. So
yeah, and part of that, like you mentioned with the conventional versus FHA loan, so the seller's concern, like you said, one thing is how much money they get, but the other is the deal going to close and close quickly, close on time? But anything that's a red flag for them of this deal might not close. So FHA, there's a couple reasons that that's a red flag for a seller. One is that FHA does do a health and safety inspection on the property, and they're pretty picky on what they look for. If there's little peeling paint and the house was built before 1978, there might be lead, and so they're like, oh, that's a safety risk, and so in that case, often people will have to go back to the seller and say, yeah, I can't get my loan unless you fix this. So they don't want that risk of having to fix something, or, if they're not willing to fix it, the deal falls apart and they have to list again. The other thing with FHA loans is they are more lenient to people with, poor credit, or they had a bankruptcy, or they had challenges. And so that says to the seller, well, maybe there's a risk they're not as financially strong, their qualification isn't as strong, it may fall through. So if you qualify for the conventional loan, it's definitely going to be a stronger offer than an FHA loan. So definitely have your loan officer look at both options. Some people will just instinctively jump to the FHA and not really compare and do an analysis on both. The other piece I want to talk about too is seller credits. So oftentimes a buyer can ask the seller to give them some money to pay for closing costs. So what the seller is looking at is how much money they're taking away after closing. So that's called their proceeds. So if you offer $300,000, but you ask the seller to give you $5,000 to help with your settlement costs, the seller is really only getting $295,000. So if you really want to offer the seller $300,000, you have to offer $305,000. So after they give you the $5,000 back, they still get $300,000. So I would say the most attractive offer would have no seller credits. But if you really do need seller credits, if you're tight on money, just make sure your purchase price is higher to compensate for that. Because in that same situation, if $300,000 was the list price, a $300,000 offer with 5,000 credits is not a full price offer. $305,000 with a 5,000 credit would be the full price offer.
Well, it also, I mean, if you can afford to do it without seller credits, it makes your offer stronger because it just kind of sends a signal that, oh, they don't have enough money saved to buy this property. But at the end of the day, a seller doesn't really care about seller credits because it gets rolled back into your mortgage. You're the one that's paying for it. But as Marla says, it is about what they're going to net. They will look at a $300,000 contract with a $5,000 seller credit as a $295 offer, not a $300,000 offer, just like Marla said. So
the other slight concern about that too, though, is if they do go in that same example with the $305,000 and the $5,000 back, there is a slight concern that now is it going to appraise out? What if the appraiser says, oh, it's only worth $300,000? Then you have another challenge. So yeah, the strongest offer is no seller credits if you don't need it. And I would caveat that with, though, that it is somewhat neighborhood specific. Some neighborhoods, it's customary that every offer has seller credits, and that's just what they do in those neighborhoods. And then it's not so much looked at as a bad thing because almost everybody does it. So that's kind of something that your realtor can feel you out on as far as that neighborhood and what the trends are and what's.
It might have to do with the price point too. A first-time home buyer price point, 200, 300,000 price point. You're going to see that more than you would say in the $500,000 or above price point for sure.
Absolutely. The other thing I would say as far as financing with having the strongest offer is just to not do any fancy stuff. I had someone yesterday writing an offer on a 2-unit property that was in perfect condition, nothing wrong with it, but they wanted to finish the basement, so they had extra living space. So she says to me, well, can we submit the offer with a renovation loan? And I said, sure you can, but you're likely not going to win the offer because when you add the fancy stuff, there's just more time, more risks for the seller, and the seller just wants the cleanest, let's get it done, let's close, let's get the deal done. And when you add fancy things like renovation loans, it's going to turn them off. So unless your offer is a much higher dollar amount to compensate for that. So I talked to her about other strategies of buying it just as it is, so you can get in the door, win the bid, and have the property. And then there's other ways to finance, finishing out the basement at a later date. So yeah, I would say nothing fancy. So the simplest, straightforward, conventional loan, you know, no seller credits, just show that you're a strong buyer. And again, if you need some of these things, you need it. If it's a property that's literally falling down, obviously you need a renovation loan. But if you're just adding things as optional because you like them and you don't need them, just be aware that your offer is not going to be the top of the stack.
Right, right. Yeah. So I think we've covered that topic pretty well.
Yeah.
But obviously, if anybody has questions, feel free to reach out to us, and we're happy to, or if you want us to look into your specific situation, we're more than happy to do that. So,
yeah, and I would just reemphasize that too, that initial consultations, there's no cost, there's no obligation. If you're just thinking, maybe I'll buy, maybe I'll sell, I don't know, don't worry about calling us. You don't have to be 100% committed. We can run the numbers, show you what it would look like. I can let you know what you qualify for. Mary can let you know what houses are available in that range. And then you can decide. If you decide not to move forward, at least you have that information to make that educated decision. So no obligation, no cost. Feel free to reach out.
right. Yeah, good, good. Sounds good. And that brings us up on 30 minutes, Marla. So let's plan to do this again. We've been doing this the fourth Monday of the month always. And hopefully you'll mark your calendar and join us next month. And hopefully we won't have the technological difficulties that we had this month. I think there's something wrong with Facebook. I don't know, but and it'll go a little bit more smoothly next time. But we've got our contact information is readily available, I think, on Facebook, right, Marla?
Oh, so, absolutely. Yep.
Yeah. So look for us there, and have a good day, rest of the day, and we'll look for you next month. Bye.